Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to Sparta Market Outlook, your weekly snapshot of what's really driving the global oil markets. So today we have the Singapore Dream Team back. So welcome back, June and Hua, and joining us as usual is Neil. Hi guys.
Hi everyone.
Hello.
Cool. So look, we've got a jam-packed docket today with a lot of new developments on China, both on export quotas and with the country seemingly returning to WTI purchases. Then we have big moves on fuel oil to explain with both low sulfur and high sulfur cracks at 1-year lows, or even more actually. Meanwhile, clean product cracks are high as we head into the global turnaround season. And there's a question that keeps on coming back to us. Do we have enough refining capacity and what is the trade there? I'm your host, Rachel Williams. Neil and June are going to kick us off today with our roundup of headlines. So guys, why don't we just get stuck in with this one?
Yeah, let's go. So I suppose we could have talked about lots of things. There was the Fed decision to cut yesterday. There's movements on the dollar. There's flat price and stuff like that. But I think there's a lot of movement on China this week, but one of the main ones keeps coming back to basically Ukrainian attacks on Russian infrastructure. And there was the headline, I think yesterday or the day before, that Russia may be close to cutting oil output. And it's an interesting one. It doesn't necessarily make that much of a difference for the crude market, but it's a symptom of possibly the tightening up of the product market because it's the Russian product exports that are declining. I saw a post online that evidence of high Russian crude exports is an argument against having to cut oil output. But I think that's just nonsense because internal demand is obviously being crimped by the attacks on refining. So that's the problem. And I remember this story from immediately post-Ukraine invasion because the problem is that they don't really have traditional storage tanks in the same way as other systems might have. Basically, Transneft is the system where they store oil, and so they have limited ability to actually build up inventory. That was always the thinking from us anyway. So it's an interesting story, and the main takeaway is it doesn't look like these attacks are actually going to stop. I think there's another 2 refineries hit this week. One of them is Kirishi, which is interesting for fuel oil, right? As a big fuel oil maker.
Yeah, there's a massive fuel oil machine for sure.
Yeah, and as far as I can tell, the biggest impact on flows so far is not necessarily fuel oil yet, but it's definitely gas oil. So gas oil exports are really dropping off. That's a big story. Less so Naphtha, which is interesting because Ust-Luga was supposed to be the main problem there, but definitely gas oil for now.
Okay, one to watch then. What else do we have on kind of the headlines this week?
China again.
Yeah.
There was a report out yesterday that they are back to buy US crude. There was some fixtures noted from US Gulf Coast to China for SAP and offloading. This is actually big news if it's true because the US import tariff is of 10% is still in place. So in our calculations, it would be uneconomic still for the ARB to work into China versus another Middle East Gulf crude like, say, Morban. But just postulating a little bit on this, if they could access very, very cheap high sulfur straight run residue and make that blend, which we talked about before, 70% WTI and 30% HSSR, you can make a look-alike PG grade, MEG grade. The econs might just work, but we still need to be skeptical about this headline.
Okay, interesting one. I know that we talked about this during APEC in terms of the option of blending. Let's see what happens when that cargo lands and see if we can get some intel in terms of what they do with it. But look, June, actually, while you're there, we had product export quotas out. Do you want to touch upon that?
Yeah, so back in, was it July now, we were saying that it should come out. It finally came out.
It's been a while. We've waited. We've been patient.
Yes. It is actually fairly flat versus the last 2 years. So the headline, therefore, is there is no big export coming out from China to rescue either the receipt or clean products, which the export is on CPP basis.
Okay. Neil, keen to get your thoughts on this.
Well, I just find it interesting. They've definitely upped runs this year. They've got the same level of product exports. Supposedly they've got weaker demand. Remember, that was one of the big stories, that their internal demand is under a lot of pressure from all the sort of new energy vehicles and stuff like that. So I just wonder what the story is. Maybe their yield is much lower and they're focusing on petchems. Maybe it's about geopolitics, as we kind of hinted at last week. Maybe they're not willing to sort of destroy the refining margin globally, as they've partnered up with some people who enjoy higher oil prices. I don't know. I just find it quite interesting. I'm not sure I have an answer, but I'm quite surprised, let's say, that the runs are so high. Demand is supposed to be rubbish, and exports are not being allowed to rise.
Okay. Let's see how that plays out in practical terms then. I'm sure it's not going to be kind of the last time that we talk about this. In June, I think you've already written an insight that's gone out kind of on some of this, or if not, there will be one shortly. But moving on from that really quickly then, the EIA actually kind of came out with a new report this week. Hands up who's read that one.
I partially read it. It's an IEA report. The title is The Implications of Oil and Gas Decline Rates. It's a really long report, 73 pages. So I'm doing a TLDR version of this. Global oil production is declining by 8% due to a rise in unconventional oil. That is tight oil and extra heavy oil and bitumen, think the Canadian crude stuff, where decline rates are significantly higher than conventional oil. So this is quite staggering. It's like 5.5 million barrels per day per year on average to 2035 that will be lost just due to natural declines. That's the equivalent of the entire current crude production of Brazil and Norway from the global balance each year. And the message is, if there is no investment into post-peak projects or new conventional and unconventional projects, global oil supply figures will fall steeply.
Okay, thank you. And thank you for the summary as well. Guys, I will be testing you on that internally over the next couple of weeks. It is a very long report. Okay, so moving on then, general margins and the refining market. One of the questions that we have been kicking around internally is, do we have enough capacity? Who wants to take this one on?
I'll take the first part at least. I think the question is about upgrading capacity rather than just the simple CDU capacity, and on the operatable capacity. Right now we are seeing, for example, Dangote RFCC, that looks to be a constant on-off running. Those forecasts as well. And we've got 4 European refineries that were shut down this year. We also know China is now not going to export products to the market prolifically. And the stocks for products-wise is not able to respond currently to very strong complex margins, while the demand is still on the okay side. Let's look at US. We've seen successes in building up the distillate stocks in PET 1 and PET 3, but it came at the expense of jet and gasoline stock. The total clean products is still on track with the 2023-2024 bill levels. But we need to watch out, because last week's the distillate bill was also a function of extremely low exports. It could be bad data or the effect of TC14. So I think we've seen, therefore, more evidence that there is an issue with the complex and conversion units rather than just the simple CDU unit, because if you get simple margins high enough, you should then get complex margins to stop the conversion. Later, Hua will talk a little bit more about the length in the low sulfur fuel and high sulfur fuel oil that's currently impacting this picture as well.
Okay, so what's the trade idea behind this and where do we go?
It sounds very supportive refining margin, but at the moment we are already really quite high, both on the margin picture as well as the individual gasoline and gas oil cracks. So buying dips during winter seems like a decent bet, unless things change materially. We'll see if any of the bullish refining news will die off as well. Yeah,
it's always a difficult one as well, going into kind of obviously maintenance, where June, kind of from your experience as well, one of the risky periods is coming up from a turnaround, and starting back up. So let's see kind of and keep an eye on kind of how they move, because that might kind of give us a little bit more issues on the capacity side or the operating capacity side. But look, Neil, it'd be good to pick these points up in terms of the distillate side and the gasoline side a little bit later on. But before we go there, Hua, you've been very quiet so far. So look, June touched upon kind of the Chinese export quotas came out. So what's the latest for fuel oil, and what do you think the impact is on your side?
Yeah, sure. As June said, we've got the third batch of the Chinese quota, which was, I think, 8.4 million tons for the clean products and then 0.7 million tons for dirty. So total for dirty now is roughly 13.9 million tons for the year. But that's not obviously, like the entire story, because you also need to take into account the fact that, some of them like Sinopec to China, Sinochem, they did all of these different, quota transfers from the dirty to the clean. And on the other hand, you have CNOOC doing from the transfer from clean to dirty. So the net impact of that is actually, I think, 300 KT less in quota for the dirty. So it's actually 13.6, versus the 13.9 officially. So we built a bunch of models recently on the production, on the bunker sales, etc. in China to kind of try to estimate impact to that export quota on the market. Obviously, we make a bunch of assumptions on production, on the sales, which includes your VLSFO, your HSFO, MGO, and also the split between them, which is not always very clear, obviously. And what we think is going to happen, the impact of the Chinese export quota is that China is still going to need to import around, I think, maybe 800 KT to 1 million tons of low sulfur molecules from September to December, or roughly about 200 to 250,000 tons per month. Basically, 2 FMXs of on-spec 0.5 from, Singapore, plus 1 or 2 MRs of the 0.1 to 0.2% stuff that they usually get from Far East Russia.
Fair enough. Is that more or less than last year? Hua?
Honestly, no exact figures in terms of the impact off the top of my head, but I think the requirement that we calculated, or rather we estimated for this year is, I think it's less than last year. I remember September last year, people were talking about like 400 to 500 KT per month of import requirements on the Chinese side. And this year, as we estimated just now, it's about 200 to maybe 250 KT. So yeah, I mean, I need to double check some of those figures, but obviously the point is that they still need to import to make up the difference, but definitely less than what they did last year. And also, if you think about it, given that we have quite a bit more supply in the global balance for low sulfur this year, it's definitely not as bullish as some people hoped before. So.
Yeah, fair enough. Okay, so look, in one of the pieces that you wrote recently, I think you mentioned the possibility of more low sulfur feedstock in the East. Are you still kind of thinking that way?
Definitely still a possibility. I mean, June talked about it just now. RFCC margins running on, say, low sulfur straight run looks very good at the moment. It's pretty much at the top of the range. And it's very good versus putting that into the VLSFO blending pool, because the value there is really, it's not exceptional right now, far from exceptional. I do think there's capacity in Asia to ramp up the RFCC runs. Obviously, we need to work out exactly how much. That's not an easy question. Yeah. We have to look at the, how much runs it is right now, and, all the capacity that we've got recently. Proper Dangote LSSR, I think it looks pretty good for feedstock. Obviously, parcel side has always been a problem in the West, even for the USGC or, Europe. Dangote is like one whole Suezmax, which is very big for a lot of these, refiners.
Yeah.
Although in the West actually take it, but Asia is where you have the biggest refineries in the world. Whether that's in China and Korea, etc. So we still need to work out the numbers. But my gut feel is that the Koreans can actually probably should take some of these Dangote molecules into the secondary units. I will save the calculations for another piece of market outlook in the next few weeks, but. I definitely think it's a possibility, but I think June also mentioned something before, that flashpoint for Dangote is high, which is it's good for like low sulfur, as in VLSFO blending. So naturally, the first choice actually it goes into the bunker blending when the values allow instead of like the feedstock side. But given that the blending margins are not exactly the best at the moment, I mean that's definitely food for thought whether it should go more into the feedstock pool in the east. Yeah.
Okay, you touched upon Dangote. Obviously, we were just talking about the LSSR. It feels like the gift that keeps giving, to be honest. It has a weekly spotlight on this podcast at the minute. But look, what's the latest situation there?
The RFCC is still down, apparently, down until December at least. I checked the tenders that they sent out recently, pretty much in line with that. So there's really no discrepancy there. Still down, still to be seen when they're going to come back. But interestingly, if we look at our break-even calculations, Fujairah is now a little bit better than Singapore when it comes to sending the Dangote molecules. So just by looking at our break-even calculations, I think that's probably where some of the recent cargoes are probably gonna head to for now. So to Fujairah.
Fair enough. So look, anything interesting that you've seen recently on the high sulfur side, just to wrap this up?
Oh, that's a tough question. I mean, we talked about all the bearish factors, like end of power burn, etc., all these different things before. But I think on the other hand we've got the Babco hydrocracking unit. I think that is coming online, if I'm not wrong, in December. So that's about 200 to 300 KT per month of non-sanctioned high sulfur that's gonna be off the market. It's gonna go into that hydrocracking unit, and I think it's important because it's non-sanctioned molecules which tend to have a much bigger impact on a market than say the same amount of Russian molecules. Then New mentioned that whole attack on Kirishi. The Russians say obviously no impact, but who knows? I mean, and Kirishi is a massive fuel oil machine. I think they produce 400 to maybe 600 KT a month of the 3% stuff. So I mean, if there's any impact, you probably feel down on the high sulfur side.
Okay, so thank you so much for that. I do love to get a fuel oil chat on the pod, so thanks for that. I'm going to give you a bit of a respite, but I am going to come back to you at the end, if that's all right, just in terms of any convincing trade ideas that you've got going into the next week or so. I appreciate that might be a bit of a challenge, but let's see where we get to. So look, let's move on to fuel oil's natural partner, crude. So look, there's been a bit of a change in the physical markets. June, do you want to talk us through this?
Sure. We are fresh off APEC, so everyone's back trading in the East.
It was very quiet last week.
Yes, but this week is a lot of news. So the first one was the VLCC Azure Nova was on subs to ARB 40s out to China for early October. The last time we had such a 40s ARB was back in July. And Sparta, we've highlighted a couple of weeks now that the 40s ARB was uncharacteristically open against Melbourne into the Far East based on our signals dashboard. So if once this is a firm up, we have basically found a relief valve, and DFL should recover, right, Neil?
It took its time, didn't it? Like we've been talking about this for like a month. Not actually quite sure what the timing is about now, but it was very cheap for ages. Yeah, I mean the DFL is doing better again. The long-awaited slight North Sea recovery is somewhat underway, I would say, but the spot premiums in the North Sea are not really responding yet. But yes, agreed. It looks like it can sort of solve itself by clearing east just now.
All right, and then we look at Brent Dubai. It's still fairly low. Many West ARBs are still wide open to the Far East. The latest news we got is that Chinese teapots have bought Brazilian 2P and WAF crudes Mostarda and Manji for North delivery as well. Yesterday we had the Qatar Energy tender results. Al Shaheen's term price was set at 361, fairly high. Qatar Marine and Qatar Land traded at lower, around mid twos, but that basically kickstart the rest of the spot trading. So we should start seeing more of the rest of the the Middle East Gulf trades coming into our pricing in a bit. But the thing that I keep hearing from everyone is Melbourne is very strong still. ICE Melbourne is currently at Dubai plus 330. We have seen it drift a little bit lower from the start of the trade month, and we still anticipate, given the strong West ARBs coming in, Melbourne itself should not stay this strong.
Fair enough. Neil, keen to get your thoughts on the crude market. You chipped in with kind of North Sea, how can I put it, very slight recovery. But what are your thoughts on the market this week?
Yeah, I mean, other than Dubai, I think I'm getting it's maybe a slight repeat of myself, but I still think it's important to highlight. I think the main problem with the crude market just now is WTI, and I'm still convinced that's true. I put out a note late last week saying that actually maybe minus 450 TI Brent would be a target. And I was right for the wrong reasons, because actually it was just TD25 rally that basically drove that. So nice, I guess, but it's narrowing again this week. But I'm quite convinced that TI is the main indicator that there's something slightly wrong in the crude market just now. So again, I think I put out that, once TD25 presumably, well, we think TD25 will stay sort of moving sideways this week. It's partly attributed to the VLCC market. The strength of VLCCs is insane at the moment, and that tends to lift the whole freight market up. So even though WTI actually looks quite expensive in Northwest Europe just now, partly because of freight, don't think the freight is the solver for the next week or two. And that means that, if WTI is going to clear again, the TI Brent spread might actually start to come off again once more. But I generally think that TI is the main problem, and that, the commercial inventory situation in the US is the main indicator of that. And last week is not a good week to judge anything by. And actually, I think the response to price after yesterday's EIA report was correct, in that there was a big draw on US stocks, but there's a crazy export number and a reduction in imports as well, which won't last. I mean, there was a doubling of exports to above 5 million barrels a day, which is, it's just statistical noise, if you like. So we should be discounting last week's report, and I think prices also tend to agree with that as well. So I think TI Brent will be a recurring theme. I think it can spend more time at wider levels over the next month, because remember, now is the time we'll actually get some seasonal builds, and last week notwithstanding, it's a more bearish time of year from that perspective.
Fair enough. Anything to add? You picked up on the VLCC rates. Anything else that we want to add there? I mean, I'm quite happy to get Michael back next week as well. We could probably do with talking about freight. Yes.
I mean, it's been a hot topic internally, of course, as well, and externally. I mean, a lot of the news revolves around rates and what it means. A lot is getting attributed to simply more exports out of the AG. That seems somewhat likely as an explanation. There's also specifically vessel tightness in the AG, so that helps. And the other thing that is getting attributed is just more vessels moving into the dark fleet. I don't think we are really super clued in on that level of the freight market, but all these things seem to be coming together. And also just the time of year, buyers, buying will start to rise post turnarounds. Another big story has been the level of Chinese buying. I've been trying to sort of touch base with a few people on that. It was my opinion that, we've got all the SPR stories hovering around, but what's changed about that? Because the Chinese have been building stock all year. So we'll see. I think there's some tendency to say that Chinese or exports to China might be on the rise on an outright basis just now. So that would also help. And it's partly helping to normalize the West-East situation, right? So the rates ex-AG for Vs are rising faster, and all else equal, it means that it's on the freight basis, it's relatively a bit cheaper to bring it out to the AG than it is from the West at the moment, and that is helping normalize Murban's position in terms of the basket in the East. But there's still a long way to go. So we were having some crazy discounts last week, TI landing at $3 per barrel discounts to Murban. Absolutely crazy. That has now halved. And the combination of freight, the combination of BDSS, and the combination of some spot declines in spot premiums in the Middle East, it's all helping, but there's still a long way to go, I would say.
Okay, I'll come back to you at the end, kind of in terms of just some trade ideas going forward. But look, in the absence of James, and I think we've lost Jorge to Singapore, to be honest, he's extended his APEC break and he's taken a few days off. So Neil, can I ask you to help me out with just a really quick rundown about kind of where we are on the clean products?
I'll start us off with the distillate. So I think we're slowly building up a case that we don't want to be too bearish for Q4, let's say. And I just wanted to pick up on what you said earlier as well, or what we were talking about. It's not a good time to be long cracks. That's fair enough. But I think it's also one of these situations where you might still want to be long, because in this type of situation where the market's already very worried about supply, if you get something else, let's say another 5 refineries get attacked, or let's say it's been a very quiet hurricane season so far, and I see there's another storm forming in the Caribbean this week, that's the type of place where prices can go parabolic if you're already tight. And so it might be worth a punt actually being long short term, just to capture that kind of thing. And I see also there's some headlines about temperatures, so we're about to get a plummet in European temperatures over the next week. So all these things can help. But in terms of the ARBs, all the ARBs are now also closing into Europe. So the ARB from east to west for Disti has closed off. It's pointing east again. That's actually counterintuitive, because the east-west has actually widened, and what's happened there is there's been a normalization in the freight. So there was a short period of Eastern barrels arbing into Europe, but that's gone. And I guess that if that is maintained, that starts to be felt towards the end of the turnaround season in terms of arrivals. And also the Gulf Coast, even though you've got some builds in the US, the Gulf Coast is struggling to maintain an open arb to Europe. Okay. The one thing that is interesting is the St. John and New York Harbor, so the sort of reverse TA arb, is now open. And we saw some vessels on subs moving volume basically from New York or the East Coast to Europe. I'm not sure that's necessarily a big flow that Europe needs to be concerned about, but it should be another thing for the HOGO, right? And we've just been wrong on the HOGO. I mean, we've been long HOGO for like 2-3 weeks and it keeps on coming off. But this is the type of situation where you might say, okay, once you start to open the reverse arb, that doesn't tend to last long, and maybe now is the time for buying the HOGO again. So let's see how that goes. Let's see how that goes. Yeah. Again, also there was a big build in US distillate stock last week. And the thing to watch out again is the strange export data, and maybe that's related to TC14. So we should be discounting that report as well. The other thing that's happening is the regrade. So the Asian regrade jumped 50-60 cents this week for October. It's partly seasonal, I mean, it is now the time where you start to need to build up stock ahead of the winter heating period. And it's just something we ought to note. And I think it is one of the additional legs of support that can help clean up the Eastern diesel market, let's say, because you will just reduce blending incentives from jet to diesel. So it's something to think about. And the regrade recovery seems to be starting in Asia. And that's basically it. I mean, the elephant in the room is attacks on Russian refineries, and I don't see why that's going to stop. It seems very, very bullish at this point in time.
Yeah, no, that's fair. Okay, let's catch up and see where the HOGO is next week. Fingers crossed that kind of works out for us. But look, moving on then from distillate, gasoline and naphtha, anything new of interest in those markets?
Okay, I'll help on this part. From Singapore, 92 spreads currently are above $2 per barrel for the first time since the summer of 2023. We've seen a combination of supply outages, Indonesia coming out to buy quite a number of spot cargoes, and also the Chinese export picture looking most in line with the 2024 levels. We have also the RFCC in Pengerang, PREF Chem Refinery, is heard to be coming back, so that should help to cool things a little bit. But the Chinese export quota feels supportive right now. Plus, we have peak turnaround in the east for Oc and North. We are going to see the fuel story will also play a big part here, because the weakness of Sing 0.5 would incentivize refining kits with the residue desulfurization units like in Korea to swing their feed, LSSR feed from the RDS into the RFCC. So the trade here is bearish Q4 Sing 92 against 0.5%.
Okay.
We look west now, EBOB spreads looks unsustainably rich, especially with the blend margins open and the ARA ARB econs firmly negative into traditional outlets. On the other hand, we know that barrels are just not available in the volumes needed to pressure the structure lower yet. The path forward is likely to be defined by how quickly all this offline capacity comes back and how aggressively incremental supply can be redirected into the gasoline pool. So when we look at our blender, the normally bearish open E5 blend margin is kind of less meaningful for now.
Okay, so summarizing kind of what we've talked about today really quickly, I did say at the start that I'd really like some trade ideas from you. Hoa has been shaking his head at me kind of for the majority of this. So why don't we move this to kind of what are the main things that we're going to be looking at in terms of evidence in the market over the next coming weeks. I am going to remove kind of the Russian refinery attacks off the table for this one. So just kind of some interesting things that you guys are going to be keeping your eye on. So who wants to go first? Hua?
What do you mean by evidence? Evidence for what?
Evidence for where we think the markets are going to go. So you guys have made some bold calls going into kind of Q4. So notwithstanding kind of Russian, refinery attacks, what are the pieces that we're going to be looking at?
I think the crude buying is definitely something to watch. I mean, we talked about this last week and during APEC as well about the TI plus HSSR combination, which I think is still a very interesting thing to kind of look at. I mean, we've got quite a number of people talking about it right now, and the econs kind of, I mean, it makes sense in a lot of places. And the other thing that we were talking about is also kind of that loss of feedstock going more into the sort of, like east of Suez kits. So that's something that we definitely keep an eye on and see if it's going to be true. But in terms of like positioning stuff, I don't know. Still, we've been bearish low so far, especially Sing 0.5 for a while. I think we've been bearish for the last 6-7 weeks. At the moment, still leaning bearish. I'm really not bullish at the moment yet, but I think getting slightly more constructive, maybe going into the second half of Q4. So probably still bearish for the next, probably 2, 3, I don't know, even 4 weeks in the second half of Q4. Slightly more constructive.
Okay.
Yeah, tapping on that, then it will be the Sing 92 to 0.5 bearish as well around the same period, later part of Q4.
Yeah,
thanks, Gene.
so if you look at that spread between like Sing 92 versus 0.5 right now, I think it's like probably one of the widest levels. Like it's historically definitely at the top of the range. And historically speaking, whenever we're at this sort of level, I think very quickly, meaning within like 2 or 3 weeks, we see that kind of spread narrow within 2 or 3 weeks. So I think in terms of the risk reward, kind of makes sense to perhaps play that trade.
Thank you both.
For crude
Jim?
as well, I think I'm going to look at the Melbourne Dubai premium. We should see it come off, although there is a lot of market chatter that maybe right now those more risk averse are unable to buy WTI. They're still going back to Melbourne, but I don't think the marginal player is there to buy at this level. So I'm expecting the Melbourne premium to come off.
Okay, thanks, Jim. And Neil, I mean, where do you want to scatter yourself today?
I'm just thinking it's quite difficult. I'm not quite sure. I think clearly I'm just getting a bit more bearish crude, I suppose. I mean, there's clear evidence, there's mounting evidence that there's more sour supply out of the Middle East. There's more sour supply out of Russia. TI's got a price problem. I mean, there's sort of ups and downs, of course, this week, partly on freight. But imagine now that Dubai softens a lot and the RB cons from west to east start to come under pressure. We know that WTI exports on average, not just last week, have recovered a lot. And the question is that a pull or a push? For me, it feels like a push because TI has been pricing so cheaply, generally speaking. So I'd be interested. I want to know the direction of TI Brent. I think that'll be an important one over the next month. I think it will widen. And I also think it'll be interesting once Dubai does soften, as we expect. How high are Brent spreads willing to go? So we've got Brent spread. The front spread is now 50 cents. I'd say that actually is pretty remarkable given the time of year. I suspect if we have a big oversupply of light sweet crude, then Brent spreads are not willing to go that high. So maybe it's a good test just to watch where the structure goes. Oh, well, it's always a good test, but I think those are the things I'm watching.
Okay. I'm definitely going to kind of remind you next week about the Hogo as well. So thanks for that.
I mean,
so
it's not my market, so I don't have to worry. I can say whatever I want.
I know. We'll have James on next week. He can kind of carry on and let's see if he's kind of still bullish. So look, that's a wrap on this week's edition of the Sparta Market Outlook. So look, we've journeyed through everything from China's mysterious internal workings and policy goals to rampant VLCC markets and problem solving on the resid market. So look, as always, we are all ears for your feedback, trade ideas, or heated rebuttals to anything that we've said. And look, included bonus points if you send us a chart or two. So we're going to be back next week, same time, with more oil market moves and madness. So until then, keep your hedges sharp, your barrels balanced, and your inbox tuned in for the next drop. Thank you all for listening.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.